Investing can seem like a complex and daunting topic, especially for beginners. However, understanding the basic principles of how investments work can open up opportunities for building wealth and achieving financial goals. This article will break down the key concepts of investing, explain different types of investments, and outline how they generate returns. What is investing? Investing involves allocating money or resources with the expectation of generating a profit or return in the future. Instead of merely saving money in a bank account, investing aims to grow your wealth by putting your money to work in various financial instruments, assets, or ventures. Types of investments. Stocks. When you buy a stock, you purchase a small ownership share in a company. Stocks are traded on stock exchanges, and their prices fluctuate based on the company's performance and market conditions. Investors can earn returns through capital gains, which means selling the stock at a higher price, and dividends, which are regular payments made by some companies to shareholders. Bonds. Bonds are essentially loans that you, as an investor, give to a company or government. In return, the issuer promises to pay you back the principal amount on a specific date and provide periodic interest payments. Bonds are generally considered safer than stocks, but typically offer lower returns. Mutual funds. These are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Mutual funds are managed by professional portfolio managers and offer diversification, which helps reduce risk. Exchange-traded funds, or ETFs. Similar to mutual funds, ETFs hold a basket of securities. However, ETFs trade on stock exchanges, like individual stocks, providing liquidity and flexibility for investors. Real estate. Investing in property involves purchasing real estate to generate rental income or to sell at a higher price in the future. Real estate can provide a steady income stream and potential for capital appreciation. Commodities. These are physical goods like gold, oil, and agricultural products. Investors can buy commodities directly or invest through futures contracts, which are agreements to buy or sell a commodity at a future date for a predetermined price. Cryptocurrencies. Digital currencies like Bitcoin and Ethereum have become popular investment options. They are highly volatile and speculative, but they offer potential for high returns. How investments generate returns. Investments generate returns in various ways, depending on the type of investment. Capital gains. This occurs when you sell an investment for more than you paid for it. For example, if you buy a stock at $50 and sell it at $70, your capital gain is $20. Dividends. Companies distribute a portion of their profits to shareholders in the form of dividends. These payments can provide a steady income stream. Interest payments. Bonds and other fixed income investments pay interest to investors at regular intervals. This interest is a return on your initial investment. Rental income. Real estate investments can generate rental income from tenants. This income can be used to cover property expenses and provide profit. Appreciation. Some investments, like real estate and certain commodities, increase in value over time. This appreciation can be realized by selling the asset at a higher price. The role of risk and diversification. All investments come with a certain level of risk, which is the potential for losing money. Generally, higher risk investments offer the possibility of higher returns, while lower risk investments provide more stable but lower returns. Diversification is a strategy to manage risk by spreading investments across different asset classes, industries, and geographic regions. This helps mitigate the impact of poor performance in any single investment. The power of compound interest. One of the most powerful concepts in investing is compound interest, which is the process of earning interest on both the initial principal and the accumulated interest from previous periods. This can significantly accelerate wealth accumulation over time. For example, investing $1,000 at an annual interest rate of 5% will grow to $1,050 after 1 year. In the second year, you earn interest on $1,050, not just the initial $1,000. Steps to start investing. Set financial goals. Determine your investment objectives, such as saving for retirement, buying a home, or funding education. Assess your risk tolerance, understand your comfort level with risk, and how much volatility you can handle. Create an investment plan. Develop a strategy based on your goals, risk tolerance, and time horizon. Choose investments. Select a mix of assets that align with your plan. Consider factors like diversification and investment costs. Monitor and adjust. Regularly review your portfolio and make adjustments as needed to stay on track with your goals. Investing is a powerful tool for building wealth and achieving financial goals. By understanding the basic principles, types of investments, and how they generate returns, you can make informed decisions and create a strategy that works for you. Remember, successful investing requires patience, discipline, and a long-term perspective.